Hello, folks. Good morning. Welcome to a new episode of GSN Invest. In this episode, we'll be looking at an important concept that a lot of people who are relatively new in the market, at least, kind of grapple with, which is the holding company discount, right? So many times you'll see a company which has assets worth, say, 100 crores, but the company is listed at 40 crores, right? Just as an example, right? And for someone who's relatively new in that market, that looks like a very exciting opportunity that you are effectively getting something worth 100 at 40. In this episode, we'll try to understand why that is, what could be the drivers that improve or decrease that discount, and from an investment point of view, what are the cases in which investing in a holdco can be attractive for you as an investor as such, right? So before we dive into this, let us start with a brief understanding of what an operating co and what a holding company is, and understand the concept of a holding company discount. We'll then move on to understanding the factors that drive the holding company discount and end with the rationale for investing in these sorts of businesses, right? So very simply, an operating company is a company that's involved in day-to-day business, right? So suppose you have a company that makes soaps. Uh, the business will manufacture soaps, go into the market, sell soaps. That is the entire business, right? Now there could be a company whose only job, who doesn't have any operating business, but whose only job is having some ownership in the operating company as such, right? So this company which just has some shares in that operating company is effectively called a holding company, right? And for the sake of this presentation, we'll use OpCo for the operating company and HoldCo for the holding company, right? So what a holdco discount effectively is say the holding company is trading at say 40 crores market cap, and its ownership in the operating company is worth 100 crores, right? So it is effectively trading at a 60% discount to its ownership in the operating company, which is the holdco discount as such, right? Now, in the Indian context, this holdco discount varies from, for most companies, varies between say 45-50% or so at the higher end to 80% or so at the lower end, right? Obviously, the higher the discount, the lower the valuation that you are getting. So typically 50 to 80% is the range for most companies. Obviously, there will be outliers where the promoter is extremely shady and kind of capital misallocation is extremely high, uh, where this discount sometimes goes to 88-90% as well. But typically for most companies, you will see the holdco discount in the 50 to 75-80% odd range, right? And but even this, right, even a 50% discount looks quite high, right? If a company has 100 crores worth of assets, even at a 50% discount, why should it trade at 50 crores, right? Ideally, you want it to trade at least the value of the assets it has. And three major reasons in the Indian context why the holdco discount exists. Primarily, the first and most important is, in India, ownership is primarily used as a means of control, right? So you will have a lot of holding companies which are also owned by the same promoter as the OpCo. And the reason for the holding company is not to kind of trade in and out of the operating company, but a more convoluted way of maintaining control over the operating company as such, right? And as a result of that, uh, the decision making will be substantially different, right? So, in a period where, say, the operating company becomes extremely overvalued, if you were just a regular investor, you would exit out of that business, and in a period where it was very undervalued, you could enter it again. Obviously, when a promoter is holding it for control and for kind of strategic reasons, they'll not trade in and out of the business as such, right? So, there is no sort of liquidity or trading that will happen for that part of the business. As a result of that, the market kind of discounts it to a certain extent, right? The second reason is within the holding company, oftentimes there is capital misallocation, right? So what can happen is that the operating company will pay out a dividend, and ideally, if you are running a pure holding company, as a responsible owner, you should kind of return the money as dividends to your shareholders and such, right? But oftentimes, what happens is that within the holding company, this money gets misallocated either to some other group company or into a completely random sort of business, right? So, two real world examples, I'll for obvious reasons not name the companies, but one holding company for a long period of time effectively earned money from its FMCG part of the business and gave it out via intercorporate deposits, etc., to its aviation business, right? And that obviously was not very sustainable for a long period of time. Similarly, another holding company, for a few years, kind of earned good money from its chemical part of the business, but then deployed it rather in a not very prudent fashion on real estate projects, etc. Right? So, when stuff like that happens, when capital allocation is not very correct or very disciplined within the holding company, obviously investors will penalize such a business, right? And the last is slightly more technical, which is even if you were to assume that the promoter can sell and return all of the money, as and when the exit event, etc., happens, there will be charges, there will be taxes, capital gain taxes, etc., that need to be paid, and as a result of which, you'll obviously not get the full extent of the uh, value of the operating company that you have on your books as such, right? So those are broadly the 2-3 reasons why a holding company discount exists in India, and the reason for the deviation of that. Right? So obviously companies which have good promoters, good kind of capital allocation discipline, will be at around 45-50% or sort of discounts. Companies which are very poor sort of discipline will be at closer to 80% discounts as such, right? And one potential theme to play is a compression in that, right? So we look at three ways in which people play this, and we'll also kind of discuss our preferred way of playing this, right? So one way that investors obviously can play it is a compression in the holding company discount, right? So I buy a business at a 80% holding company discount, that goes to 50, and I make money of that holding company discount improvement, right? This is a relatively tricky bet to play, because historically, even after the catalysts play out, this sort of compression doesn't really happen, right? So when you think about the reasons for compression, you would think that if say kind of governance improves, capital allocation improves, this sort of discount should start compressing, but that typically doesn't happen as fast as such, right? So betting on a business, purely betting on the holding company discount to kind of compress, uh, hasn't really worked too well in the Indian context, right? So two other things that could make it a good option is the dividend multiplier sort of play, right? So obviously, if you have say a operating company which is a 2% or a 2.5% dividend yield business, and you have a holding company at a 50% discount, effectively when you're buying the holding company, assuming all of the dividends are passed back to the shareholders, you get a 5% dividend yield play on the same underlying business, right? So that makes it a more attractive play from a total return standpoint. That even if the kind of underlying discount doesn't compress too much, you'll still make an additional 2.53% on your return over the operating company returns as such, right? So the dividend multiplier play, especially for your higher discount sort of players, becomes a good way to play that. Obviously, you need both two things, right? You need one, a good high sort of dividend yield at the operating company level, and you need good disciplined capital allocation at the holdco level for this sort of thesis to play out. But if you have evidence of both of those playing out, the dividend multiplier play could be one good way to play your holdcos. And the second way to play it is in cases where the opco has become too expensive, right? So if the opco is now trading at say 60-70x sort of valuations, and long term you want to be holding that opco, but you don't want to hold it at 80x. But if you have a holdco which is trading at a substantial discount, and what happens during periods of this very high improvement in opco valuations is that the holdco discount increases even further, right? Because obviously investors in the holdco keep kind of penalizing this, assuming that this valuation isn't very sustainable over long periods of time. The holdco discount during peak opco valuations will kind of increase, and if you have seen that sort of a trend play out, and you want to continue having exposure to the opco without having the risk of that valuation derating in the opco, you can instead choose to at least temporarily over the next 2-3 years invest in the holdco, get benefits of the kind of growth in the opco business, but as the kind of opco valuations kind of come down, and as this valuation, as the discount again tapers, you can then kind of switch back from the holdco to the opco as such, right? So that is a more tactical play to play during times where the operating company becomes a bit too expensive as such, right? So three broad ways to kind of play this theme, and we've kind of also spoken about our two preferred ways to bet on that as such, right? Obviously, if you like this video, please do consider subscribing. We are in the relatively early part of our journey, looking to get to 1,000 subscribers. So every new subscriber that we get is extremely useful and valuable to us. So if our content was useful and valuable to you, please consider subscribing. Thank you so much.